Alright, welcome to our weekly update on the Australian property market, where we discuss waves, impulsive waves and corrective waves around Australia. You may be wondering, where are we standing in the bond cycle? Since bond yields dictate whether markets are going up or down, I thought I might help you determine what's the next move in the short term, mid-term and long term on the bond yields. So why bond yields are so important, you may ask? They are closely correlated with the short-term rates and indirectly with long-term interest rates. If interest rates go down, the credit gets cheaper and you get a fresh injection of liquidity into the system, which promotes investments and consumption. Injection of currency in turn causes its dilution, hence higher inflation, which results in higher prices of everything including houses, commodities and food. Outside of the political effect of this phenomena, called the wealth effect, you don't get much bang for your buck. As the sugar hit is temporary and in the long run, it requires a bigger dose in order to keep this drug addict in shape and prevent it from collapsing. So while you get a creation and proliferation of jobs and services like restaurants, dog groomers and nail parlors, your manufacturing base is getting decimated as a result of higher prices of land, energy, commodities and salaries. Your economy turns into a zombie, an eggshell driven by consumption, the process which is successfully hidden from the public, who enjoy the sensation of paper wealth, supported by a promise that someone else is going to pay more for their houses, stocks and Bitcoin. That's until the trust in credit is weathered to the point that potential buyers are nowhere to be found. Something we are going to see in the US bond market at some stage. If no one is willing to buy their government obligations, knowing that over the past 3 years they have created 40% of their currency that has ever been in circulation, and knowing that their deficit keeps growing exponentially, that would be an endgame for their bond market. As a result, they will be forced to dramatically raise bond yields to make it attractive to buy their worthless paper. That in turn will cause a huge spike in official interest rates. Now, because all currencies are being kept in check by the Bank of International Settlements, you don't really see major shift in price relatively to other currencies, as they are all being diluted in a similar fashion. Therefore, you get the same injection and devaluation of currency all around the world, the same house bubbles, and the societal changes that result from it. So if you enjoyed price hikes so far, you're gonna love what central banks and governments have prepared for you now. Also, if you like what you've learned so far, you're gonna love the rest of the video. So give it a thumbs up to show how much you loved it. After this short introduction, let's get an analysis of bond yields. It looks like we have entered the final stages of this painful cycle of rate hikes that started in March 2020. That's supposed to have started in 2024 as projected by the Politburo of RBA. We could have saved precious deposits of so many young people who have entered the market in the middle of the pandemic and the recession. Now they are at the forefront of the household budget stress. Like all other markets, bond yields are governed by the same principles. Here is a short-term analysis of the last fifth wave within the larger first wave up. Wave 1, Wave 2, Wave 3, Wave 4 and the final fifth wave. My target for the market top is around 6%, but I can't guarantee it's going to end up there. What happens after, you may ask? We are going to descend into Wave 2. As bond yields go down, so is the projection of interest rate hikes. Central banks around the world are going to announce drops in rates or simply stop hiking. This means more sugar. All markets are going to melt up. Therefore, we are going to see final hikes in our own real estate market. Credit is going to be cheap once more and readily available. Expect more nail parlors springing up on every corner in your hometown. So if we zoom out, you will see how it all evolved since 2020. Here is 5 waves up. 1, 2, 3, 4, 5, And now we should expect 3 waves down, starting probably next week or a week after. It may go as low as 0.575, but the resistance line is also at 1.285%, which seems to be more probable. It's hard to tell how deep it's going to go. What's more important is what's going to happen after. As low interest rates are going to goose up all markets, the wealth effect is going to make people feel more comfortable with spending their not so hard-earned money, at least those who are sitting on assets. Everyone else is going to face higher prices and rents. It's going to be truly schizophrenic, as you'll see more companies going bankrupt and shedding staff as things will get more expensive. While markets are going to go higher, it's going to cause a major rift in the society, with younger generation calling for distribution of wealth, while pensioners will try to keep their pensions despite being paper millionaires who struggle to pay their bills. The pressure is going to lead to an inevitable solution that the society is going to call for. That is compromise on the property rights, which is the very fundament of Western society. In terms of the charts, this is what probably is going to happen. Once we hit the 1.285% mark on bond yields, the inflation is going to get so hot that there will be voices from the establishment that we need to cool it down. How hot do you think it may get? If we have already reached 7% on CPI, and if you take the measure used back in the 1980s, it's more like 14%. Well, the rule is, if you want to fight inflation, you need to match it with interest rates or go higher. So, did we really try to fight it over the past 3 years? With the 12 consecutive interest rate hikes, it doesn't look like it, given that rate's supposed to match inflation at least 7%. So I believe it was only a prelude to what's coming next, given that the deficit keeps growing with another proxy war and the arms race that the US is waging. We should expect huge spending and a huge surge of inflation over the next year, well above 10%. Are we going to hyperinflate? It's hard to imagine it, but it's going to be so bad that central banks are going to increase rates following the move in the bond yields, but it's going to be way too late to stop it. So gradually bond yields are going to go higher, and after a short correction we should expect a massive spike, potentially as high as 11%. And that's not the end, as there will be more pain to come, and it won't be stretched over decades like back in the 1970s, which corresponded with the last huge spike after the decoupling from gold. It lasted exactly 10 years. This time round, the first wave has spiked in just about 3 years. It's going to be truly spectacular. As a result, all the assets that are in any way bound to credit are going to plummet, as there will be no more buyers to feed currency into the system. Or the other way, there will be no bank willing to lend currency at 15 or 17%, knowing it would be a tremendous burden for any borrower to pay it back. As a result, the spikes that we saw over the last 3 years, caused by extra loose monetary policies, are going to go in reverse and are going to turn into dips of the same amplitude, which often happens at the beginning of the drops. So imagine a drop of 32% just in the first year or two in housing. It's going to get ugly. What is going to trigger such drops, you may ask? I have no answer. However, there is a chance we are going to have another banking crisis, which is already in the making, as we learned from the recent headlines. The banking system is still in trouble since September 2019, and only the emergency measures like COVID and wars are keeping it afloat, providing excuses for extra injection of liquidity. Eventually, higher yields are going to kill more banks, including local Australian banks, which is going to centralize the power in very few hands. But that's a story for another day. Meanwhile, stay calm and count waves.